Let's talk about how bonds payable. We're going to talk about how to account for bonds payable on my books. So bonds payable is a liability account. And so the normal balance would be credit. If I sell them at more or less than the face value, when when the maturity date comes, whenever the 10 years comes along or 5 years or whatever it is, the face amount has to be repaid. So if it's a $100,000 bond, in 5 years, whatever I sell it for, I owe $100,000 on bonds payable. So my bonds payable must equal the face value at the end of the maturity or the end of the term. So let's take a look at three different scenarios. First, we're going to look at what happens these are the journal entries. What happens when I sell the bond at face amount? So this is the data you're always going to need. The face amount or face value is $100,000. Contract rate is 12%. Interest is paid semi-annually. This is extremely important, and we'll talk about that in the appendix when I explain how to price the bond. It is a 5-year bond, and market rate is 12%. So the first thing you look at, 12% contract, 12% market. So we know market equals contract. If you wrote down what I told you to write down previously, then we know we sell it at face value. So of all the things on this slide, the only variable will be market rate. That will be the only thing that may ever change. So let me show you the journal entry. So here's what's going to happen. I'm going to sell you a $100,000 bond today, which means you're going to give me your money and I'm going to give you a bond. Here's what the journal entry would look like. I'm going to get my cash, so I'm debiting my cash, creating a credit on my bonds payable. And so this is the journal entry to sell the bond at face value. Now, we have to figure out, I'm going to have to do a journal entry every time I send you a payment. So the first thing we're going to have to do is remember from chapter 8, the formula of principal times interest times time, we need to figure out the interest payment. So right here, every 6 months, we're going to send you $6,000. And here's what happened. I take the principal times the interest. And by the way, this is always contract interest rate. It doesn't change. In this formula is contract interest rate times 1/2 year. And the reason we're doing a half a year is because I pay the bond interest semi-annually. If I paid it annually, this would be times 1. If I paid it quarterly, this would be times 1/4. So every 6 months, you're going to get a check for $6,000. That will never change. Here is the journal entry for the first interest payment. Now, I'm going to ask you, what would be the journal entry for the second interest payment? It would be exactly the same every 6 months. It would look like this. Every 6 months, I would send you a check for $6,000. So this would be the first interest payment, the second one, the third, all the way down. This was a 5-year note. Let's go back a little bit, guys. Sorry about that. This was a 5-year note paid semi-annually. 5 years times how often a year I'm paid twice is 10. So you're going to get 10 checks, and that's called the periods. The periods are 10 periods. Okay, so this is the interest payment. At the end of the 5 years or the maturity date, here's the journal entry to give you back your money and debit my bonds payable. So the bonds are no longer on my books at this point in time. This is bonds issued at face amount. Okay, so now we're going to talk about what happens when I issue them at less than face amount or at a discount. So the same data. Here's a $100,000 bond. My contract rate is 12%. Again, that is a constant. It never changes. Paid semi-annually over 5 years. That's 10 checks or 10 periods. But market rate is 13%. Okay? So I'm going to show you the journal entry on the next slide for selling at a discount. The appendix will explain how did I get that number, and we'll go back to that after the videos. So I'm actually going to sell it for $96,406, and I got that because my discount amount is $35.94, and I will explain that at the end of this chapter. So I'm going to get your cash for $96,406. I'm going to have a brand new account called Discount on Bonds Payable. This is a contra account to the bonds payable. It's kind of like depreciation and accumulated depreciation. Normal balance is a debit, where the bonds payable is a credit, and I'm going to owe you $100,000. So here's what's going to happen. I will pay you interest over the period of time of $6,000, and at the end I'm going to pay you back $100,000. So let's talk about what I'm going to do with this $35.94. So what happens is the $35.94 is in the discount on bonds payable. So the carrying amount, so remember in equipment we had the book value of the equipment, we had the equipment minus the accumulated depreciation. This is the same thing. It's the bonds payable minus the discount on bonds payable. It's called the carrying amount. So the carrying amount of my bonds right now is $96,406. At the end of 5 years, the carrying amount has to equal the $100,000. And in order to do that, we have to amortize it over a period of time. Okay? Amortize means I'm going to take a portion of that amount and take it off of discount on bonds payable. I really wish I was in class showing this on the board with you guys, because it would make much more sense. So to amortize on a discount, this is kind of the journal entry we're going to talk about. Actually, we're going to use this journal entry down here. We're going to debit interest expense, and we're going to credit discount on bonds payable, and I'm going to send you the cash. The cash amount I send you will always be the interest payment of $6,000. That will never change. So here's the journal entry that we'll be using. Now, there's two different types of amortization. We're going to talk about straight line, and then there's effective interest rate. This will be in the appendix. For the most part, I'll be talking about straight line method. Okay? So straight line is easy to use. It's basically divided by a certain number, and every time I send you an interest payment, I'm going to take a portion off. It's like straight line depreciation. It's always exactly the same number. So here we go. Here's our data. So discount on bonds payable has a debit balance of $35.94. It's 5 years times twice a year, so we have 10 periods. So I'm going to take this amount, divide it by 10, and every time I send you a payment, I'm going to credit 1/10 of it off for the interest. Here's an example. So here's the cash I'm going to send you, $6,000. That will never change. You're always only going to get $6,000. Discount on bonds payable, here's the credit for $359.40, which is 1/10 or 10% of the total that was in there. And I add the two together to get my interest expense. So here's something to write down. When I'm discounting a bond, interest expense will always be higher than the interest payment. This is the interest payment. This is the interest expense. So I'll say that again. When I'm discounting a bond, or when I have a bond discount, the interest expense is always higher than the interest payment. So what I'm going to tell you next is that this is the journal entry for the first interest payment. Remember, I'm going to make 10 of them. Every 6 months you're going to get a payment. Well, this is exactly the same interest journal entry for the next interest payment, and the next one, and the next one. So I'm going to do this 10 times until my 5 years is up. When my 5 years is up, my discount on bonds payable will have $3,594 in it as a credit, but it'll also have the same amount on the debit side, and then it will be, the carrying value will be 0 for that bond. Okay, so this concludes bond discount and how to calculate for interest payments. Next, we're going to look at bond premiums.